You can sum up today's big interview this way
I love gold.
or this way.
It looks very much as if we've established a new floor in the gold price at somewhere above $3,000 an ounce. The floor last year was at $2,000 an ounce. That is a huge leap, and it wouldn't surprise me if gold were to consolidate a little bit in this 3,000 to 3,500 kind of area. It wouldn't surprise me. It wouldn't even disappoint me. I think gold is doing what it does, which is it holds value when other things are losing value. And I think that that's the main reason why people own gold.
That's George Milling Stanley, Chief Gold Strategist at State Street Global Advisors. And in today's big interview, he'll talk about the optimistic case for gold, why it has been a very strong hedge for geopolitical risk and even the tariff policies we've been talking about, but not a great hedge for the inflation we've seen. But up first, Christy Akulian, head of iShares investment strategy for the Americas for BlackRock, is here talking about Tuesday's Consumer Price Index release and what it means that investors should be thinking about when it comes to making mild portfolio tweaks now. Plus, Kerry Setti, head of consumer insights and research at Voya Financial, is here discussing their survey, which showed that more than 1 in 3 working Americans are saying their ability to save for retirement has already been severely impacted by economic uncertainty.
Come on, it'll be fun.
I don't know that the economic uncertainty will be fun, but the show today will be a lot of fun. This is Money Life for May the 14th. I'm your host, Chuck Jaffe, and yeah, it doesn't get much bigger than guests from BlackRock, from iShares, and from State Street Global Advisors. It does not, and I love this lineup because I always have a blast chatting with George Milling Stanley. And how can you not like talking about gold this year when gold has done so well? How can you not like talking about gold when gold has been sort of a story that hasn't been well discussed for a while? In January of 2023, you entered 2023 with the gold price at $1,850 roughly per ounce. And you peaked earlier this year with gold at $3,300 an ounce. It's in the $3,250 range as we start the day, but George Milling Stanley makes a case that it's got room to get above $3,500, so that's another 8 or 10% from here. Now, of course, you heard from Tally Leger just the other day that he thinks stocks have the room to run, and there was running that was done yesterday. We'll see what we get in terms of the numbers today. Now, the Dow Jones Industrial Average finished yesterday off slightly, but the S&P and the NASDAQ continued their run. But when you get moves like the two strong moves we've seen the last couple of days after the news of the tariff hold-off, well, that winds up typically having a couple of days and then it resettles. The market kind of brings it back. So we will see what winds up happening. But I will point out that with stocks having climbed out of a big hole, one of the things I plan to do is to talk to you on tomorrow's show about what you might do next. And this will, again, when everything happened and you had the market tanking right after Liberation Day, I talked about what was happening, for example, for Gale. And I'm going to be talking about some of that again, because with the market having climbed out and Gale having felt worse than she had about ever really looking at her portfolio, it's time to try to make sure that some of those things are protected against not whatever could come next, but that she's got a portfolio that is more age appropriate. Gale has always just set aside as much money as she could. She's done great that way. And she's also basically tied it all to the market, which has not been a bad thing to do. But now where she's a lot closer to using it, you talk about sequence of return risk. Well, you maximize that if you've got full market exposure. And she's starting to understand how that could come to roost. And mind you, probably you're hearing this going, but Chuck, you didn't just step in and immediately take over? No, she's an independent woman. Only when she I let her know I'd be there the whole time. Tell me how I can help. But so it's only now that she is saying, yeah, maybe I want this help. If you want my help, Chuck at MoneyLifeShow.com is how you reach me, and I'd love to be able to help you if I can. And if I can't, I'd love to get you answers for your questions and more. But I love the feedback. I think we've got a higher level of feedback. You know, we lost Rich in Orchard Beach, Maryland back in February, and a significant loss. And as I told you, Rich wrote me about every day, pretty much about every interview. And I really love that some of you have picked it up and let me know what you're thinking, et cetera. And I very much appreciate the kind words you've had for some of our recent interviews. But I think our recent interviews have just continued a trend of being really thoughtful on how to deal with the situations that we're all going through. And that's an important thing to recognize, because there are definitely times where, money managers are different from you and me. They invest without worrying about the bills to pay. But they're also human beings, and they do have bills to pay, and they are looking at this. And, I have these great conversations that you hear. I also sometimes have great conversations off the air, and it's good to know that they are human, that they are real people. And yeah, they're impacted by it. I think that has helped make it more that they're looking for answers to give you and me, but they're also looking for those answers for themselves. Hopefully, we're going to give you some answers. What a great show today. Again, Christy Akulian from iShares, from BlackRock, here talking consumer price index and what it means. Kerry Setti from Voya with an early level survey that may be dramatically changed as they take the next iteration of it, but still worth thinking about because the tariff numbers haven't shown up in inflation yet. And then George Milling Stanley on gold. It's a great day to live the money life. We will prove that to you when the talk starts after this message.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
We start this edition of Money Life by going off the news, and specifically off of the Consumer Price Index news. Joining me now to talk about it, Christy Akulian. She is head of iShares Investment Strategy Americas for BlackRock. If you want to learn more, iShares.com will get you more information. Christy Akulian, it's great to have you back on Money Life.
It is great to be here. Thanks, Chuck.
So the CPI numbers came out, April CPI print came out below estimates. It was 2.3% up year over year. There's a lot of different ways to break it down, but what we were maybe expecting was more impact from the tariffs. What we got was maybe less impact from the tariffs. And of course, we started this week with the news that the biggest of the tariffs will be put off at least for a while. But that doesn't mean that the potential impact of tariffs isn't going to show up, does it?
No, not at all. And to start with the inflation print that we got, I would characterize it as almost entirely benign, right? There's not too much to get worried about. And so you saw markets be able to rally a little bit on the back of it. But, digging underneath the surface a little bit, it came in largely in line with expectations. There were very few, if any, signs that this inflation print included any of the impact of the tariffs that went on in April. So, we were looking to see if maybe some of that started to leak into the data for this month. The answer that we got is really no. We're going to have to wait for future month CPI data to see what some of the impact of those tariffs was. The one place that I would point to that we were looking to that maybe bears a little bit of attention going forward too is, while this inflation print was cooler than the market expected, there's also such a thing as too cool, right? And so we were looking to see if this showed any sign of consumer slowdown. If we were seeing the consumer pull back in a meaningful way, that has implications beyond, inflation. That can look at GDP and to the growth picture more broadly. So we saw a little bit of weakness in airfare. We saw a little bit of weakness in automobiles. And those can actually suggest that, the consumer stepping back a little bit. We'll need to pay attention to those categories and that concept in future iterations as well, just to see, to make sure we're not too hot from tariffs, but we're not too cool from a consumer pullback too.
From the standpoint of the inflation that was expected related to tariffs, most of that wasn't really what we thought was going to happen from tariffs. Most of that we thought was going to be driven by the fact that consumers wanted to get ahead of them and were spending and maybe disrupting supply demand equations, right?
Yeah, I think so. And if you look and you squint pretty closely, you can maybe see a little bit of uptick in some of the electronics categories, maybe in furniture, and places that are expected to be the hardest hit by the tariffs. But really, I think what this shows us is just that we haven't seen companies reset prices. And that's what we're going to need to wait for future months to be able to see. So you could squint, you could see maybe a tiny little, a tiny bit of influence from some of that pull forward economic activity, but again, very benign, nothing to get too concerned about here. And I think the market really looked through that.
Because we haven't seen those price increases yet, is there some worry on your part that when we see the tariff impacts, that they will be bigger? In other words, uncertainty, tough to act on uncertainty. Economists say uncertainty is economic deadweight, et cetera. So we didn't know how tariffs were going to play out. Now we still don't really know how tariffs are going to play out. We could be 30%. We could be back to something much bigger than that in fairly short order. On the one hand, wait and see is good. It means that, yeah, nobody's paying a higher price now. On the other hand, it means that when they hit, they could hit like a sledgehammer, right?
Yeah, and I think that that's the concern. And we've been talking for a while about the biggest risk to the economy duration of how long uncertainty could extend. So there's a time element to uncertainty. I will say though that I think that the news that we got out of the US China trade truce yesterday, say that, 5 times fast. I do think it was a meaningfully positive development for the market. It certainly didn't remove all uncertainty, but it was something of a risk clearing event. And I think we have a cleaner line of sight now in terms of both the floor and possibly the ceiling of what some of these trade deals are going to look like. And so I think that was behind a lot of the optimism that you saw. The S&P 500 closed up for the year today, for the first time since Liberation Day and some of the announcements of those tariffs. So I do think that we just have a little bit more of a picture of what the end result of some of these tariffs is going to look like, what the end game and the landing zone of what this can look like. And I think that's what allowed markets to really rally. And then I think the benign inflation print today, not that it necessarily added to it, because again, it doesn't necessarily include the impact of the tariffs, which, will impact for at least some amount of time. But it was enough that markets could look through it and continue to look forward to a slightly less hazy outlook for the future.
Did it also give us a clearer picture of what we should expect from the Fed? Because if the Fed is going to be data dependent, this data suggests they're going to wait longer before they make rate cuts.
And I'd argue that yesterday's news, or the US and China trade deal, was probably more impactful for the Fed than inflation data that we got on Tuesday was. Let me contextualize that is, I think that as the Fed was concerned about the tension between their dual mandates, there was probably a belief that Chair Powell was going to be slightly more concerned with the growth element if that actually looked like it was deteriorating much more quickly than expected. The news that we got yesterday, and the de escalation in terms of trade terms between the world's two largest economies, is really growth positive. So we're less concerned about the growth side of the equation. So there's less need for the Fed to cut. I think today's inflation data didn't change the equation all that much, in that there's less need for them to keep it high as well. So they're going to continue to be patient and wait and see. But I do think that this signals a little bit of investors being able to act. So the Fed is still data dependent and they're going to need to wait and see. Investors feel a little bit more confident in the outlook for both growth and also, the outlook for what trade policy is going to look like and where it might land.
Well, let's talk about what investors who might feel more optimistic ought to do with it. Because obviously, when you're reading this stuff in your role, you're trying to say, hey, what does this mean for the portfolios that we run? So let's start on the stock side. What should people take out of this from the stock side of things in terms of what's going on with tariff negotiations and what to make of the CPI?
Yeah, absolutely. So I'll give you a little bit of history and then I'll tell you how we have updated too in recent days. So, we have, since the onset of tariffs and since even kind of the threat of tariffs started to emerge in February, we had been recommending that for the near term, investors think about low volatility or minimum volatility strategies. We like things that kind of smooth out the ride a little bit, maybe capture a little bit less of the downside than they do of the upside. So USMV is our minimum volatility ticker here at iShares. We've been, having a lot of conversations with investors about how that can be used in a tool in a portfolio. I would say that the developments and the improvement in the trade policy outlook, and sort of the trade interactions globally that we've seen over the last couple weeks, it removes enough of the uncertainty that I think our base case now is we feel more comfortable going into something like the quality factor. So QUAL. So it is a slight increase in risk appetite as a result of a slight decrease in uncertainty. But I think really most importantly for most investors, this is going to continue to be an environment that remains volatile. And we think that staying very, very nimble is one that can make, a decision that can make the most sense. So DYNF is our largest active fund here at BlackRock. That is the dynamic factor rotation ETF. Something like this is the easy button for how you want to think about being able to rotate between different factors and different themes as we ricochet between headlines and continue some of this volatility.
Does this change any of your outlook for equity investors when it comes to international investments? Because obviously, everything that you just mentioned there, whether it is the minimum volatility or the quality factor or the active rotation ETF, are all USA funds. It's been foreign markets that have been leading with all this uncertainty. Is some of that recommendation that, hey, you expect to pick up in domestic markets, which of course we've seen some of, but also is it a statement at all on what people should be doing internationally?
Yeah, no, it's a really, really great point, and it's a lesson that we have learned over the course of 2025, and that is that diversification works and diversification matters. So, when asked, should investors be adding to international equities right now? My answer is almost an unqualified yes. Part of that is because we've found from our conversations and our portfolio analysis is that most investors have drifted away from benchmark and they're actually materially underweight international markets. So, do we think that now is a time to go massively overweight once we've already seen some of the performance run up this year? Maybe not, but do we think that this is a time to address those underweights and get closer to benchmark and closer to a broadly diversified international global equity portfolio? Yes, I think so. I think that that same theme of quality can really make sense internationally as well. So we're thinking about IQLT, maybe a little bit of ticker alpha there for you. International quality is easy to remember. I think that can make sense in this environment where it does make sense to be very, very deliberate about diversification, and geographic diversification is incredibly important as well.
So that takes care of domestic and international stocks. What does this mean for fixed income portfolios and fixed income strategy?
Yeah, certainly. So, we get asked the question a lot about, US exceptionalism. I think coming into this year, the market had probably hit fever pitch for US exceptionalism. And then, maybe the unwind of that trade got a little bit overdone in the last couple weeks as well. So, we do still believe that the US is a great place to invest, but I would maybe separate out the question a little bit between equity markets and fixed income and currency markets. So, well, I think, we're still very confident in, I'd say we're still even a little bit overweight US equity markets. It's not necessarily the case when we think about US dollar exposure or when we think about duration. I think that this is an environment, as we've seen, where you need to think beyond duration for diversification. So, all sorts of factors in the US, which the market is not currently thinking about. So, things like inflation expectations moving higher, things like the deterioration in the fiscal condition of the US, all of those can lead the long end of the yield curve to stay high or move even higher. So we're not relying as much on duration right now within a fixed income sleeve. We're thinking a lot more about income, and we're being really deliberate about where we get that duration exposure with a preference for the front and the belly of the curve as opposed to the long end. So a ticker like BINC, BINC, just the BlackRock Income ETF, we again focusing a little bit more on income over duration and really separating out some of the ways that you can be again diversified in a portfolio. We covered it on the international front within the equities. On the fixed income side, I think it's moving beyond just a reliance on duration.
Christy, great stuff. Always is when we get a chance to catch up. Thanks so much for joining me again on Money Life.
Thanks so much for having me.
That's Christy Akulian. She is the head of iShares investment strategy for the Americas for BlackRock. You want to learn more? iShares.com for more information. We've got a lot more to go on the May 14th edition of Money Life. Later, the big interview will feature George Milling Stanley, Chief Gold Strategist from State Street Global Advisors. But up next, we're talking about a survey that has some really interesting tariff-related news.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at Vetify.com.
Now Money Life looks at what the survey said. Yes, this is the survey said here on Money Life. It's where we look at surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at some research from Voya where they were talking about tariffs. And they talked about how investors and savers are finding that tariffs are gutting their retirement dreams. And I know you might think, well, wait, they took that survey and then we just saw a change in how the tariffs are going to be applied. But the ongoing discussion throughout all of this has been how much of the impact of tariffs is long lasting. And while there was tariff uncertainty, you had plenty of people who were starting to say, this is becoming a problem for my long-term savings. Here to discuss it, Carrie Setti. She is head of consumer insights and research at Voya Financial. You can go to voya.com for more information, or you can look for the direct link in our show notes that will get you directly to the study results. Carrie Setti, welcome back to Money Life.
Thanks so much for having me back, Chuck. Great to be here.
The timing of this one could have gone either way, right? You could have said, oh, well, now that we've had a change in tariffs, maybe this isn't a problem. But my sense was that the problems that were being reported here were big enough that tariffs may be resolved for the next couple of months, but the problems are going to linger, aren't they?
Yeah, I mean, we're doing a number of different surveys, and the one that we just fielded in April really showed that, for at least a third of Americans, they say that tariffs and the ongoing economic uncertainty has really impacted their ability to save for retirement. So much so that we even see the same amount, about a third, saying that they're going to delay or strongly consider delaying their retirement because of tariffs and economic uncertainty.
Well, that's a problem because they assume that they can
Right.
delay their retirement, right? Like saying you're going to do that, oh, I'll have to work longer or I plan to work longer is not the same as having your employer say you can work as long as you want.
Right. Especially because, I mean, we do a fair bit of retirement research, as you can imagine, and retirement is often unexpected, right? It can be something like a layoff or unexpected job loss, but also loss of health sometimes for themselves or their spouse. And so, they say they're going to work longer, but what we often see in the EBRI data is that the actual retirement age tends to be sooner than planned. So, a lot of these sort of, perceptions around the impact of tariffs really has, especially those closer to retirement, such as boomers, saying that they're going to have to work longer.
There is at least a theoretical positive, right? Because while we have economic uncertainty around tariffs, and while you could say that inflation is certainly going to take a bigger bite, tariffs or not, inflation's been running higher for the last couple of years than it had for the decade before that. What we are also looking at is people who are saying, I'm changing my decision making or it's impacting my decision making. We always warn people from a stock perspective, don't get whipsawed, don't be scared out of the market. You always have people saying, this is no time to panic, as if there would be a time to panic with your money. Like that would be a good strategy. There's no time to panic. But when you have the folks making these decisions this early, that should be a good sign that folks are at least going, hey, I'm aware this is going to impact me and I can try to do things even if I think the outcome won't be great, right?
Right. And what we see is, from our American consumers and especially those who are, currently working full-time or part-time, we're seeing that many of them are actually starting to make some changes today. We see about two-thirds, say that they're changing their spending habits as a result of all the market uncertainty. Of those, we see about 60% are saying that they're spending less on non-essentials. We also have conducted tons of qualitative research, to try and understand, well, why are they doing this? And what we're seeing is that many are just sort of scared. They're saving more just in case things go, sideways. And then also we have to remember, right, especially coming off of, peak inflation of 2022, we're seeing that there is really inflation scarring. So it's this idea that tariffs are going to raise prices for consumers, and they're worried about that on top of potential layoffs and other factors that are really just, again, it's that uncertainty and market volatility that really leave consumers feeling uneasy, and therefore they're starting to pull back on those sort of, non-essential spend.
There is some research in here that talks about how many folks are tapping or expecting soon to be tapping their emergency brakes on this and what they've got to help them through. And those numbers are alarming, aren't they?
Yeah, I mean, the good news is that, especially with inflation, we have seen a heightened focus around building emergency savings. But when you have sort of this uncertain economic environment and you have, tariffs in the news and headlines every day, we're seeing that more and more people are saying they need to save for an emergency, and especially things like unexpected medical expenses, right, which tend to hit households pretty hard. And so they're sort of trying to build up that savings, but at the same time, if especially the lower income earners, we have seen some signs of, increased job losses or lower income. They are starting to have to spend down some of that savings for those essential items.
It would surprise no one to learn that if we did this survey along political lines, folks who are Democrats would wind up being much more pessimistic than folks who are Republicans. But while that does skew the results if your things were party neutral, the truth is there's plenty of nervousness on the Republican side too, correct?
Yeah, and we do look to other sources, like Morning Consult does a really great job of tracking those views by party lines. We did ensure, though, in our research that we have a balanced view of the American public, or, across the political affiliation. So the results that we're seeing are sort of, representative of the entire US population. But in some of those other data sources that I mentioned, we are seeing pretty dramatic differences across party lines. But even in April, we did see some sort of where they were kind of coming together, especially on the topic of tariff uncertainty and how that might impact things like price increases. So even with our balanced representative sample, we are seeing that nearly two-thirds, so 64% of US consumers are saying that tariffs ultimately will cause an increase overall in prices.
Kerry, really interesting. Thanks for joining me on Money Life to talk about it. I hope we get a chance to chat with you again down the line.
Great. Thanks, Chuck. It's fun.
That's Kerry Setti. She is head of consumer insights and research at Voya Financial. It's voya.com if you're looking for more information. And there is the direct link in our show notes or where you find Kerry on our guest page at moneylifeshow.com that will get you directly to the survey talking about Americans and how they're responding to tariffs and more. We are responding to only the fact that we've run out of time here, but we've got more time today on Money Life. So settle back and relax because survey said, well, hey, there's a 100% chance that Money Life will be right back with more talk in just a moment. Welcome back to Money Life, where it's time for the big interview on the May 14th show. Returning to Money Life today, George Milling Stanley, and he is the chief gold strategist for State Street Global Advisors. If you want to learn more about the firm, ssga.com. If you want to learn more about George and what he does, well, check his bio, which you can do. There's a link to it in the show notes for today's show. George Milling Stanley, great to have you back on Money Life.
Chuck, it's always good to talk with you. Thanks a lot for the invitation.
As we are doing this interview, we just got the inflation print. The news was, I think, kind of in line with what folks expected, but there's a lot of uncertainty because, well, we might have more inflation. We certainly have more tariffs, but tariffs are not as bad as we thought they were going to be just, over the weekend. So help us understand, because gold has not been a great hedge for inflation of late, but it has been a great hedge for geopolitics. So what's your base case on gold, given what we're seeing happening to the markets in response to tariffs?
I guess the first thing to say is that we haven't had the kind of inflation that gold is a very good hedge against, historically speaking. And that is, gold is not a good hedge against sudden shifts in the rate of inflation, whether up or down. It's not a good predictor of inflation. Where gold comes into its own as far as inflation is concerned is when we are suffering sustained high inflation. Let me define those terms for you, Chuck. By sustained, I mean a minimum of 2 years. And by high inflation, I mean inflation going up by 5% or more every year. We haven't really had a sustained period of high inflation since the 1970s. When we did have that, the annual average appreciation in the gold price during that period of sustained high inflation was around about 15%. Which is pretty good, given that other things are not generally performing very well during periods of high inflation. So that takes care of the inflation issue. If we do get inflation at that sort of level, 5% or more a year, for a sustained period of time, I would expect gold to continue to do what it's done before, historically speaking, in the face of sustained high inflation. As far as everything else is concerned, I think we have, no question, you mentioned geopolitical uncertainty, turbulence between India and Pakistan. Is the ceasefire going to hold? They still have problems in the Middle East. No question about that, in spite of some progress, but we don't really have anything that's looking like a settlement. And we don't seem to have been able to make much pressure with the dispute, the invasion of Ukraine by Russia. So we still have a lot of geopolitical turbulence, and gold historically has tended to perform well during periods of geopolitical turmoil. But we also have significant uncertainties as far as macroeconomic data is concerned. We still haven't seen much in the way of data since Liberation Day on April the 2nd, when President Trump first started to announce details of the tariffs. Since then, tariffs have been on again, off again. Jerome Powell is going to be fired. Jerome Powell is not going to be fired, but he will be replaced when his term is up as chair in May of next year, and so on. So we've had a lot of uncertainties that has brought back in investors' minds the fear of a possible recession. The Fed is in wait-and-see mode, as they told us last week. They're definitely in wait-and-see mode in terms of interest rate cuts. They are still very concerned about inflation. The latest print, I'm sure, will give them some comfort with the lowest inflation rate in 4 years on the CPI, but I don't think it's going to solve all the problems. We still don't know where we stand with interest rates. We are currently on a 90-day pause as far as tariffs are concerned. We don't know what the outcome of that is going to be. So we still have an enormous amount of uncertainty on the macroeconomic front as well as geopolitically, Chuck.
And so given that uncertainty, I mean, gold is off its record highs, but you can see them from where we are right now, like it's in sniffing distance. At the very least, do you assume that gold basically has more upside than downside in these kinds of conditions?
I think that would be a fair statement of the current situation. Look, we went up very, very quickly over the last 18 months or so. We didn't make a sustained breach of overhead resistance in gold at the $2,000 an ounce level until February of last year. That was when we made a sustained breach, and we haven't been below $2,000 an ounce since February of last year. That's only about 15 months or so ago. We went up through 3,000 very, very quickly, and all of a sudden you turn around and we're at 3,500, which is where we were recently on the all-time high. And then there was suggestions that maybe the tariff issue is not going to be as bad in terms of its impact on our economy. It's not necessarily going to be inflationary. We don't know what's going to happen. We are still faced with uncertainty. And when faced with uncertainty, I've always turned to gold in the past, and I think it's served me well.
As for the potential here, given that you've had that big run in gold, breaking through 2,000, got to record highs of 3,400, it's in the 3,250 range as we record this. While it's got more upside than downside, is the range a little more narrow because we've seen so much run? Or given the uncertainty, the higher the upper limit?
I think that your last phrase there is absolutely right. The higher the uncertainty, the higher the upper limit. The team that I'm part of at State Street has had to revise our forecasts on a couple of occasions already this year from the forecast that we made last December, which was supposed to last for the whole of 2025. But gold really, really motored in the early part of this year. So we've had to revise our forecasts. I guess the most important thing to say is it looks very much as if we've established a new floor in the gold price at somewhere above $3,000 an ounce. The floor last year was at $2,000 an ounce. That is a huge leap. And it wouldn't surprise me if gold were to consolidate a little bit in this 3,000 to 3,500 kind of area. It wouldn't surprise me. It wouldn't even disappoint me. I think gold is doing what it does, which is it holds value when other things are losing value. And I think that that's the main reason why people own gold. We have upped our base case currently to suggest that gold in the remainder of this year will trade between 3,100 and 3,500. And our bullish case suggests that we could actually take out whatever resistance is available at the $3,500 area and possibly even trade as high as 3,900. So that's our bullish case. But as I say, the important thing to me is the establishment of that new floor at around about the $3,000 an ounce level, $1,000 above where the floor has been for the last 15 months or so. So I think that has been a major achievement for gold. And I think people are still looking to gold for its protective attributes rather than necessarily hoping that the price will go up so they can sell at a profit tomorrow or next week. And I think that those protective attributes, you and I have rehearsed these in the past. The first one is that gold has no relationship with stocks or bonds. Statistically speaking, it's a zero relationship. And that's offering you a level of diversification. I can't think of another asset that could match that level of diversification that gold historically has offered investors. In addition to that, Gold has a long track record as offering some protection against sustained high inflation, not the sort of inflation that we've seen over the past few months, but sustained high inflation. It also has a good track record as offering some protection against sudden declines in equities, which is still in the minds of many investors a major possibility, given all the macroeconomic uncertainties that we're facing. I mean, if you look at Black Monday in 1987, if you look at the bursting of the dot-com bubble in 2000 and 2001, you look at the global financial crisis of 2000, you look at the advent of COVID in 2020, equities took a significant downturn and gold performed very, very well. It either held value or it actually increased quite substantially in value. Again, another level of protection. Gold has in the past offered some protection against a declining dollar, and it does seem as if the dollar is perhaps not going to re-climb up to the kind of heights that we saw in the earlier months of this year. It seems that we have established something of a declining trend, even if the last few days we've seen sort of upward moves again. I think in the light of all the uncertainty, I think that we're going to see further dollar weakness down the road. So I think gold is doing exactly what it should be doing. The other thing to mention, of course, is that every once in a while, like last year, the price was up 27%. This year, at one point, we were up more than 30%, and we're still up quite significantly year to date. And I think when you get protection plus performance like that, that is a very powerful mantra for investors.
Is the performance coming from both physical gold and the miners? Given these conditions, do you have a preference for owning gold or owning gold miners?
I think the performance is coming from gold bullion itself, whether that is in the form of physical bars and coins or physically backed gold exchange traded funds. I think that's really where the momentum is coming from. We haven't seen that momentum carry over into the gold mining stocks to anything like the same extent. And that doesn't really surprise me. I think that, gold mining companies are companies, and in the minds of the stock market, they are subject to the same kind of impacts that affect financials or pharma or technology companies. They're subject to management performance, their skill at mergers and acquisitions, whether they're in the right business, whether they're in the right geographical location. All of those are major inputs to determine the stock price of gold mining companies, along with movements in the price of gold. As far as gold is concerned, the only thing that is affected is the price of gold. That's what determines the price of gold. Very simple. So there's a lot of other things going on that need to be taken into consideration when you're buying gold mining company stocks. Another thing to say, I mentioned that gold has a good historical track record as offering some protection against downturns in the stock market. The problem with gold mining stocks, they can be a very good investment when gold's going up. They can be a good investment when the stock market's going up. But whenever the stock market is turned down, then gold mining company stocks have often tended to follow the market down. And I think that they're not offering the same kind of protection that exposure to gold bullion actually does.
I know, because I've asked you about it before, that you are not someone who is big on crypto. So I don't want to delve too much into it. But there are still plenty of folks who are saying that crypto is digital gold or is it behaving like digital gold. How have you seen that argument hold up as we've gotten to a point where Bitcoin, for example, is at record highs, trading at over 103 at this point, whereas gold has not gotten back to record highs?
Digital gold to me is a very strange kind of phrase. I don't see the cryptocurrencies offering the same kind of protections that gold does. Protections against portfolio concentration, protections against inflation, protections against equity weakness. Basically, Bitcoin, when it was launched in 2009, really didn't correlate strongly with anything. And that definitely sparked my interest at the time. But since then, I think that Bitcoin has tended to track much more closely with the S&P 500. And over that period, the S&P 500 has come to be dominated just by seven tech stocks. And I think that Bitcoin has tended to behave more like a tech stock in recent months and recent years for that matter. I think that Bitcoin can offer, cryptos in general have offered very, very good performance for the most part, not every year, but very good performance for the most part in the 15 or 16 years since Bitcoin was first invented. But I don't think that they offer the protections that gold offers. So I think the two can coexist quite happily in a portfolio. The one thing I would say to people is if you go into the crypto universe in the quest for greater returns in your portfolio, by all means do that, but be aware that you're also exposing your portfolio to a much higher level of volatility, and it might be a good idea to reconsider exactly how much you have allocated to the principal volatility hedge in your portfolio, which in many cases is going to be gold.
Yeah, it's important, I think, for people to understand that last point, because if they consider Bitcoin and lump it in with gold, whether they buy the digital gold argument or not, a portfolio that says, oh, I'm going to have a 10% gold hedge, but splits that hedge between gold and crypto is very different than a portfolio that is, 60, 30, 10, for example, with the 10 being all gold, right?
I understand the appeal of returns. I'm not shy about looking for returns as well. But I do think that people should be aware that they are adding a level of risk might concern them and that they might want to protect against the added level of risk that they're putting into their portfolio. I don't see the digital gold argument because I don't see the principal reason people, I believe, are buying gold and have done for centuries has been for its protective attributes. And I'm not seeing those same kind of protective attributes in the cryptocurrencies right now.
Given the volatility that we have seen, do you worry that if we see a tariff setback, that would be the thing that triggers gold? Or again, because gold is not correlated to the stock market, tariffs will send the market careening, but they won't have that kind of impact on gold?
Look, I think if someone were able to wave a magic wand and all of this uncertainty about tariffs, the uncertainty about the inflationary potential for some of the other policies of the new administration, the immigration, for example, immigration policies may well put upward pressure on US wages. There's talk of tax cuts. Nobody's done anything yet, but there's talk of tax cuts. They can be inflationary depending on who they're aimed at. If someone were to wave a magic wand and all of that were to disappear completely, I think that there are still very, very sound reasons for people to want to invest in gold. The geopolitical turbulence is certainly one. And I think that we are not necessarily out of the woods if just those uncertainties are actually put to bed, laid to rest, whatever cliche you want to use. There are still very, very good reasons why people would want to invest in gold. Central banks, as you know, we've talked about this in the past, central banks have been strong net buyers of gold for 15 straight years. They've had a pretty good start as far as the first quarter of this year is concerned. We're expecting a pretty good number for 2025. It may not equal 2023, 2024, where we saw massive numbers, but it will still be a pretty big number. So there's that. We've seen a significant revival in investment demand throughout the emerging world for a whole bunch of reasons, many of them local. The Indian government reduced tariffs and taxes on gold imports at their budget last year. And that, I think, has been very, very helpful for gold investment in India. China, still concerns about the real estate sector and just how effective government support for economic growth is going to be. And then, of course, we've seen a big revival in Western world investment because of the recession fears that have grown up alongside all the uncertainties that we've had on the macroeconomic front in this country. All of those things are not going to go away, even if the uncertainty about tariffs went away. There are still plenty of other uncertainties out there. And I think that gold historically has demonstrated very, very thoroughly its ability to offer some protection against that kind of uncertainty.
Ultimately, we've heard a lot about tariffs, and there are still plenty of people out there who they're not buying gold the way you and I are talking about it. They're not thinking about it as a hedge. They're just thinking, I want to ask this woman to marry me, or I want to get married and have a gold ring, or whatever it might be. We know that some of the countries that supply gold are countries that we are seeing significant tariffs potentially imposed on in the rest. Should anybody who's out there who says, I need to buy gold, but I'm not buying it as an investment, I'm buying it for the reasons why you buy gold for jewelry and what have you, should they expect that they're going to see inflation above and beyond whatever's happening with the gold price just because we've got, the additional levels of tariff and things happening on this stuff?
Well, look, as far as anything about the tariffs issue is clear at this stage, I think the administration has been pretty clear that precious metals were not to be included in any of the imposition of tariffs against anyone. So I don't think that that's going to be an issue for people. If gold prices go up, that might be an issue. Maybe this could be a wonderful buying opportunity, Chuck. I hesitate to suggest that, but maybe this could be a really, really good buying opportunity for gold, given the recent pullback that we've seen from those highs, and given our belief that those highs could well be tested again later in the year.
George, great stuff. As always, thanks so much for taking the time to join me.
Chuck, I really appreciate the invitation. I enjoy our conversations every time we have them. Thanks so much.
That's George Milling-Stanley. He's Chief Gold Strategist at State Street Global Advisors. SSGA.com if you're looking for more information on the firm and its ETFs and more. And we'll be back to put a bow, not necessarily a gold bow, just a bow. Wrap this one up and tell you what's coming tomorrow. So stick with us till the end because the finish line is in sight. We're back to wrap things up. Thank you so much for staying with us. A lot of fun talking to our guest today. And, I don't do this very often because I don't think it's the right way to judge guests. But here we are, we're a podcast. We are a small show, a small operation. And BlackRock is one of the biggest financial services companies in the world. It has somewhere north of $11.5 trillion in assets under management. State Street Global has, I want to say, like $4.5 trillion in assets under management. Voya, relatively speaking, only has like $400 billion in assets under management. And I know $400 billion, you go, that's big. Yeah, no, not relatively speaking. That means that we had 16 trillion in assets under management represented here today. And it's not how you want to judge the guests, because you've heard lots of things from folks who were at much smaller companies. But throw in the fact that we had David Kelly on the show and JP Morgan has about 4 trillion. And we had Vincent Reinhardt on the show and BNY Investments has like 2 trillion. When you start talking with those guys and you're hearing from those guys, it's not just that their opinions are smart because they've worked their way up to big companies. It's that you are dealing with folks who have an impact, right? If they're the investment strategists and they're coming out and saying, this is what we are doing with our money. Well, what you and I do with our money doesn't really affect anything but our household. But when BlackRock comes out and says, hey, we're moving up the risk scale, if there are a whole bunch of their clients who go, okay, let's move up the risk scale, trillions of dollars are moving potentially. That's part of the fun of having them on the show, knowing that influence, et cetera. It's also good to hear them say things like,
yeah, it's awesome to be on your show.
Which George Milling-Stanley and I always have a blast. You can bet we chat off the air and talk about all sorts of things as we're getting set up. Tomorrow on this show, somebody I have a blast with as well. Andrew Foster from the Seafarer Funds is coming back. Emerging markets have been doing really well this year amid all of the turmoil stuff. Well, that's his specialty. And it's been too long since we've had him on the show. I'm thrilled that he's going to be back here tomorrow. So make sure that you are here too. Meanwhile, if you're looking for something to celebrate today, it's National Dance Like a Chicken Day. Yeah, it is. So you can do that. It is also National Decency Day, National Third Shift Workers Day, National Underground America Day, where you're supposed to go find the things that have been built and done up underground. It is National Receptionists Day. It is Root Canal Appreciation Day. Ouch! Not sure I appreciate root canal. And on the food front, you have your choice of really kind of breakfast foods because it's National Buttermilk Biscuit Day, and it's also National Brioche Day. And quite honestly, it's not that you can't use either of those things for lunch food or what have you. But for me, if it's going to be National Buttermilk Biscuit Day, then I might want it to be National Biscuits and Gravy Day. Mm-hmm. My guests today were Christy Akulian, head of iShares Investment Strategy for the Americas for BlackRock, iShares.com, also BlackRock.com. Kerry Setti, head of Consumer Insights and Research at Voya Financial, Voya.com, and George Milling Stanley, chief gold strategist at State Street Global Advisors, SSGA.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly thanks to you for being here because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from poker legend Doyle Brunson, who sadly passed away 2 years ago today, who said, "A man with money is no match against a man on a mission." Well, we'd like it if you both had money and were on a mission, the mission to get to where you want to go with your financial goals without upsetting your life. And we want you to be on a mission to keep things in perspective, which means we want you to remember, until we do this again the next time, best thing you can do for your money is not worry too much about it. Have a great day, everybody. We'll see you here again tomorrow.
Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
My micro mechanism thanks you. My computer tapes thank you. And I thank you.